Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's good to talk with you.
Mike, what's going on at the Federal Reserve? Are they going to hold their interest rate hikes, or are they going to start hiking again?
Well, it's interesting. The past, let's say, 2 years, in 2021, when the market started to go down that year, we had a bear market. People were predicting all these interest rate cuts. They're saying there'd be no inflation, and it never happened. I'm talking about the first part of that year, and rates have gone up. They never went down. And as we entered this year, they went up more than expected. Even though the Federal Reserve did not raise rates at the last meeting, they left the window open to do more, and they relatively, the rates have gone up higher than what was expected. And what has now shifted in the stance in what the markets are pricing in, the bond market, and I'm looking at Fed fund futures as we speak, isn't more rate hikes. In fact, the odds are now that it's only a 36% chance that they're going to raise rates again by the end of the year, and it just be one more rate hike. That's not great odds. So in other words, the odds are they're not going to raise rates. However, what has kind of changed since we last spoke is that the odds of when they were lower interest rates has been pushed off into the future. The Federal Reserve, when they had their last meeting, basically suggested they're going to keep them up at an elevated level. They increased their GDP growth estimate a bit for next year. And the Fed fund futures, a couple months ago, were predicting all these rate cuts coming starting really in the spring of next year. Now that's not there. In fact, there's only an 11% chance of a rate cut by June, which isn't very great. So that's impacting the markets a little bit. I think that's an explanation why gold has been weak or trending down. Really, it's going sideways since April. April is about when the outlook of what the Fed would do compared to earlier this year, got more hawkish, and gold started to go sideways, the dollar started to go up. But I think what people need to realize is that we have other forces that are now at work, and the oil market has come alive. Oil's hit over $90 a barrel. We've seen 2 oil production cuts this summer. I just read an article this morning in the Wall Street Journal saying basically that Saudi Arabia and Russia, they want oil above $80 a barrel, that Saudi Arabia at this point almost needs it in order to fund their budget deficit. And Russia obviously needs money because of the war that they are fighting against Ukraine. So there's no reason to think that they're going to start pumping oil and make oil fall. It looks like we're headed for $100 oil at the least by the end of the year. That's what oil analysts are projecting. That's why energy stocks are now the hottest thing in the market, pretty much the only thing trending up. Sure, you can see things bounce a day or two, or but relatively, I think a lot of markets are just going sideways. But what is happening is with the economy, although there's no reason to think GDP growth is negative or about to go negative, it certainly does appear that the momentum in the economy is being hit by inflation. There are signs that consumers are being forced to pare back their spending in order to pay all their bills. And one example of this and how it can impact things is after 2020, and they began to so-called open things up, there was an explosion of pent-up demand. People had a lot of savings in the United States and elsewhere. Many people, they just had this extra government money, and if they were retired, they could pocket that money, and then they had it. And then when things opened back up, people said, I don't want to spend, all my time in my house scared. And they began to travel, and there's a boom in the travel industry. And one of the industries that boomed was the casino industry. In fact, last year they had record gambling revenues in the United States. The casinos were simply booming, and that boom continued into this year. But I can tell you that probably stalled out since July. And I think probably a lot of things are starting to slow down. So this slowdown in growth and consumer spending, I think would suggest that the Fed is probably done raising rates, which is what the Fed Fund futures suggest. However, I don't think we're in a recession now. So we're in a weird situation where overall, I think the stock market is going sideways. We're really seeing sideways action in gold since, let's say, March overall. And I think people have to figure out and think, what happens when the sideways action is over? And in my view, I believe the risks in the stock market will be to the downside, because I think eventually we will see these interest rate cuts, but they may start a year from now. And if they do come and people keep wanting them, it's going to happen because the economy is contracting, and not just slowing down in the growth, but a recession. And, one happens inevitably at some point. So in the stock market's already had this huge rally in the beginning of the year. Stocks are not that far off, some of them, where they were at the highs of last year. And particularly the technology stocks, valuations are high, earnings are sluggish, and interest rate increases are hurting the margins of companies that have to pay, they have a lot of debt. And when they buy and issue bonds now, it's at higher rates, just like everyone in the world is being impacted by higher rates that have credit card debt or other types of debt. So are corporate America compared to where things were a couple of years ago. Obviously, we're not going back to the way things were before 2020, something I said over and over and over again last year. So if the stock market's a little risky, I would suggest that gold and silver has the potential to get out of this sideways trend and have a big upside move at some point in the next couple months. But at the moment, it's still going sideways. Because I think when you do get to that moment where the Fed says it becomes clear to people they're not going to raise rates, and one day in the future they're getting ready to cut, that'll benefit gold and silver, but that's months off. It's not weeks away that becomes clear to people. But if this correction or sideways action in gold continues for the next couple, weeks or maybe into December, I can't really predict it. But at some point, it would come to an end. I think we'll have a good buying opportunity.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, is the shine off high tech, especially AI now, or is that still just sucking in so much money everybody else is suffering from it?
Well, it was a meme to chase, and people chased it until it's not really working anymore. People need a reason to buy stocks other than they're just going up. What they'll do is they'll see them going up and then want a story or some explanation for why they should jump in and believe that they're going to go up for a very long time. They need a reason to believe. And AI was the reason given this year that there's going to be all this, change and this stuff, and it's going to make everything efficient and simple. And it was something new that everyone was able to get on their phone or their computer and play with Google Bard and other chat bots. And it was a new thing, and new's fun, but new got boring. I don't know very many people still playing with this stuff. And there weren't really any companies other than a couple big cap technology companies that, trading on the stock market that were real, that you could think are going to make money. The thing is, it was a story. It was a meme. Just like Metaverse was a meme, a year and a half before. And these memes were out, and they're not the real reason stocks go up and down. They're just the story. So what is the real reason? And that's what you have to deal with. And the real reason is these markets go in cycles, and you have bear market declines, which we had last year, and that bear market ended, cyclical bear market. And then after it ended, we had a cyclical bull market start. Between October and January, that's when things turned around. Various markets around the world put in bottoms or lows in October or November of last year. Europe went up first. Actually, gold and silver led the way. Then Europe took off, and then the United States market heated up in January, and the NASDAQ heated up in January and took the lead. And then that's when the AI story appeared. But that story, took into the mind of financial media and the imagination of investors playing the markets months after the rally began. And they weren't saying on television, hey, this is a new cyclical bull market. No, they were saying AI, 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 and yelling at it. People, Kramer yelling, other people yelling. And the problem is they don't want to say this is a cyclical bull market, because cyclical bull markets don't last forever. And if you compare the way this market is or was likely to trade out to past cyclical bull market, which I think I did with you sometime in the first quarter, I was citing the work of Walter Deemer in January, who demonstrated in a study, he put on the internet, that we had these so-called thrust days in the market, which 90% of the stocks are up, multiple ones, in January. I'm speaking of the United States market. And history shows when that happens, you have the start of a new cyclical bull market. Well, a cyclical bull market isn't one that lasts for 10 years. It's one that lasts from 2 to 5 years. And in my view, and I was saying this then, and I'm going to say it again, this bull market that began then is probably most similar to the type that we're seeing in the 1970s, in the late 1960s. And that was an era, just like now, defined by high inflation that would come and go in spurts. And that's what we're living through. And those cyclical bull markets, typically, back then, the gains would all come in the first couple months, and then you just start to go sideways. And that sideways action could last a year, and then things would pretty much roll over into a bear market as the economy contracted after the Fed has raised interest rates like they've done, and inflation has actually gone down, which it hasn't really. The rate of inflation, is still close to 4%, barely below it. So the Fed hasn't hit its goal of 2% yet. So I think that's what we're living through, a sideways movement, and most of the gains in the stock market, if not all, have already been made. So there's no real great upside potential. And this is a message. I mean, I can tell you on your show, because you have your audience of people and they're pretty smart, but I can't make like a YouTube video talking about this stuff and expect YouTube algorithms to push it out to people, because it's just not a very fun thing to hear. It's not what people want to hear. They want to hear about how they can get rich in the markets, buy something now and it's going to go up forever, when it's a weird moment where there's not much really to do. It's oil and energy stocks that are doing the best now. That's about it at the moment.
So are we setting up for a major correction this fall, or is it just going to stay flat?
I think we're going to see a little bit more weakness in the next few weeks. Nothing crazy, but I would guess that we'll see a low made probably before the next time we speak, which that's probably 3 or 4 weeks or something. We'll have earnings come out, by the second half of October, earnings season starts. So I think we can get a rally or bounce back up when that begins. And so I'm basically looking at overall sideways between now and the end of the year, with a little bit more weakness in the next 2 or 3 weeks.
Anything else you think we should be keeping a close eye on right now?
Well, I just had this other thought that kind of makes me believe also in this stuff I'm talking about, these cycles, is in these stock market bull and bear cycles in the economy, there is typically a order in which various sectors outperform, underperform, and so forth, meaning that there are times when some sectors do the best. And it's very interesting and telling that it's the energy sector that's now doing the best in the market, because historically, that sector, when it does the best towards the end of a cyclical bull market, not at the start. And that's exactly what's happening. And that doesn't mean I think everything is going to collapse or something, but it just, to me, confirms the type of cycle we're in, that's the stuff doing the best.
Mike, thank you so much for chatting with us.
Thank you. Good to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or for any of our guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on X @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.